Welcome to my channel. Today we will be talking about the best uncapped funding model, fixed term versus line of credit. When I was first scaling my business, the question of funding was crucial. Specifically, choosing between a fixed term loan and a line of credit felt like a huge decision, and frankly, a bit overwhelming. Both models are often uncapped in terms of potential use, meaning once you have the money, you can typically spend on any business need. But they operate very differently in practice. I've personally used both, and here's my takeaway. Fixed-term loan. Predictability for big investments. A fixed-term loan is straightforward. You get a lump sum of cash all at once. You agree to pay it back over a set period, the term, with a fixed payment schedule that includes principal and interest. My experience. I used a fixed-term loan when I needed a large amount of capital for a specific one-time investment, like purchasing a new, expensive piece of machinery. The pros were predictability. I knew exactly what my monthly payment would be for the next 3 years, which made budgeting very easy. The downside? Interest starts accruing immediately on the entire lump sum, even if it takes you a few months to spend all the money. It's a great tool for a well-defined growth project, but it locks you into a repayment schedule regardless of your monthly cash flow. Line of credit. Flexibility for working capital. A line of credit, LOC, is different. It functions more like a business credit card or an overdraft facility. You're approved for a maximum limit, and you can draw funds up to that limit whenever you need them. My experience. I found the LOC to be a superior tool for managing working capital and handling cash flow gaps. For example, when I had a sudden surge in inventory demand but was waiting for a large invoice payment to clear, the LOC was a lifesaver. The biggest advantage is that you only pay interest on the money you actually use. And as you pay the balance down, the credit becomes available to borrow again. It's revolving. This flexibility is huge for seasonal businesses or dealing with unexpected operating expenses. The drawback, however, is that the interest rate is often variable and sometimes higher than a fixed-term loan, and there can be additional fees like annual or draw fees. The verdict: there's no single best model. It depends entirely on your business need. If you need a large, one-time sum for a major, planned investment with a clear ROI, the fixed-term loan offers better rate predictability. If you need a safety net for day-to-day operations, inventory fluctuations, or unexpected cash flow needs, the line of credit is a far more flexible and often cost-effective choice, as you control when interest starts and stops. In my journey, I learned to see them as complementary tools in my financial toolkit, each serving a different strategic purpose for business stability and growth. With that being said, thank you for watching. For more finance videos, kindly check my page. Please like, share, comment, and subscribe to my channel. Thank you.